Hello. When you reach a certain season of life, the game changes. It just does. For decades, the focus is on growth, on accumulation, on planting seeds and watching them sprout. You're looking out across a long, open horizon. But then you arrive at a different vantage point. The horizon is still there, of course, it always is, but your relationship to it shifts. The goal is no longer just growth for its own sake. It becomes about sustainability, about reliability, about peace of mind. You've built your orchard over a lifetime of work. Now the priority is to tend it carefully, to enjoy its fruit, and to ensure it endures for all the seasons to come. This is the mindset of the retiree or anyone approaching that chapter, and it requires a different kind of investing philosophy. The thrill of the hunt, the speculation on the next big thing, that fades into the background. What moves to the forefront is quality, durability, and perhaps most importantly, a steady, predictable stream of cash returns. You're no longer just an accumulator of capital. You're a steward of a livelihood. That's why the search so often turns to dividend stocks. And that's a sound instinct, but it's also a field fraught with traps. High yields can be sirens, luring investors onto the rocks of unsustainable payouts or failing businesses. Chasing the highest number can be a recipe for sleepless nights and permanent loss of capital. At this stage, the loss of capital is a far greater risk than missing out on a potential gain. So today, I don't want to talk about the highest yielding stocks. I want to talk about the highest quality dividend stocks, the kind you can buy, put away in a drawer, and sleep soundly knowing they are working for you. The kind run by businesses with unshakable foundations, wide economic moats, and a profound cultural commitment to sharing their success with shareholders through good times and bad. We're looking for perpetual motion machines, not flashy fireworks. Now, I need to be clear, I am not giving you personal investment advice. I don't know the particulars of your situation, your needs, or your risk tolerance. What I am offering is a framework for thinking, a way to evaluate what quality truly means when your primary need is dependable income and preservation. And I will share with you 3 examples, businesses that, in my view, exemplify these principles. They are not obscure picks. In fact, their familiarity is part of their strength. True quality doesn't need to be complicated. Let's begin by defining our criteria. What makes a dividend stock high quality for someone over 60? It's not one thing. It's a combination of characteristics that form a formidable whole. First and non-negotiable is the durability of the business model. We need a company that sells something the world needs or deeply wants, consistently and in all economic weather. Its products or services should be as close to essential as possible. Think about it. In a recession, will people stop brushing their teeth? Will they cancel their morning coffee? Will they forego their electricity? Probably not. We want businesses that are utility-like in the steadfastness of their demand. They have what I like to call a wide and deep economic moat, a sustainable competitive advantage that protects their profits from invaders. This could be a powerful brand, a low-cost production advantage, a regulated monopoly, or massive scale. The moat ensures the company isn't in a constant knife fight where profits are competed away. It allows for stability. Second, we must look at the financial fortress. The balance sheet is paramount. We want a company with minimal debt, or at least debt that is easily manageable relative to the cash it generates. A strong balance sheet means the company can survive and even thrive during economic downturns. It doesn't need to beg from nervous bankers when credit tightens. It has the financial strength to continue investing in its business and, crucially, to continue paying its dividend even when times are tough. Excessive debt is a risk amplifier, and at this stage of life, we are risk reducers. Third, we examine the history and culture of sharing. A long, unbroken streak of dividend payments is a powerful signal. It shows a corporate culture that prioritizes returning cash to shareholders. But we must look deeper than just the streak. We need to see a history of growing that dividend. A company that regularly increases its payout is demonstrating confidence in its future earnings power. It's a tangible sign that the business is generating more cash than it needs to reinvest, and it's choosing to share that prosperity with its owners. This combination of a long history and a pattern of growth speaks volumes about management's discipline and shareholder-friendly ethos. Fourth, we consider the payout sustainability. This is where we avoid the sirens. A very high yield, say 8% or 10%, is often a warning sign, not an invitation. It can mean the market believes the dividend is in danger of being cut. We want a payout ratio that is comfortable. That means the company is paying out a reasonable portion of its earnings, or better yet, its free cash flow, the cash it actually generates after necessary expenses. A low to moderate payout ratio provides a cushion. It means if earnings dip temporarily, the dividend is not immediately threatened. The company has room to maneuver. Safety of the principal and reliability of the income stream are our guiding stars. A modest growing yield from a rock-solid company is infinitely preferable to a high precarious yield from a shaky one. Finally, we think about relevance for the future. We're not looking for relics. We're looking for timeless enterprises that have also adapted to remain relevant. Does the company have a plan for the next decade? Is it investing in its moat? Is it run by able and honest managers who think like long-term owners? The business doesn't have to be a Silicon Valley disruptor, but it cannot be a buggy whip manufacturer either. It must have a pathway to enduring relevance in a changing world. With this framework in mind, durability, financial strength, sharing culture, payout safety, and future relevance, let's look at three businesses that, in my opinion, stand up to this rigorous test. Remember, these are examples to illustrate a philosophy, not a prescription. The first is a company that is practically woven into the fabric of daily American life and increasingly the world, Johnson & Johnson. Now, you might think of them as a Band-Aid company, and they are, but they are so much more. Their business is organized into three segments: consumer health, the Band-Aids, Tylenol, Listerine, pharmaceuticals, a massive portfolio of innovative medicines, and medtech, everything from surgical sutures to joint replacements. This is the very definition of durability. In good times and bad, people get sick. They need health care. They require medical procedures. The demand for J&J's vast array of products is resilient. It's a business built on the unshakable foundation of human health. Their moat is profound: a trusted household name brand in consumer products, a deep pipeline and patent protection in pharmaceuticals, and entrenched relationships with hospitals in medtech. Financially, it's a fortress. They carry a very manageable debt load for a company of their size and cash-generating ability. Most importantly for our discussion, they are a dividend king. This is an elite title for companies that have increased their dividend for at least 50 consecutive years. Johnson & Johnson's streak is over 60 years. Think about that. They have raised their dividend through recessions, oil shocks, market crashes, and pandemics. That is a culture of sharing, institutionalized. The yield is typically modest, often in the 2.5% to 3% range, but it is backed by one of the most durable business models on earth. You're not getting a sky-high yield, but you are getting something perhaps more valuable, a near certainty that the check will arrive and grow for the rest of your life. It's the bedrock holding. The second company operates in a sector often considered boring, but boredom is beautiful when you seek reliability. Procter and Gamble. If Johnson & Johnson cares for you when you're sick, Procter and Gamble cares for you every single day from dawn to dusk. Tide detergent, Pampers diapers, Gillette razors, Crest toothpaste, Charmin toilet paper, Downy fabric softener. Their portfolio is a map of daily household rituals. These are not discretionary purchases. They are consumable necessities. The beauty of this model is its repeat purchase nature. A bottle of Tide is used up and another is bought. This creates an incredibly stable, predictable revenue stream. P&G's moat is its brand empire and its unparalleled scale and distribution. It's virtually impossible for a new company to walk into a Walmart or a supermarket and displace the shelf space and consumer trust that P&G commands. Financially, it's another fortress. They generate oceans of free cash flow with remarkable consistency. And like J&J, P&G is a dividend king with over 65 years of consecutive annual dividend increases. That's a record that spans generations. It speaks to a management culture that views the shareholder as a partner. The yield is similarly in that comforting 2.5%-ish range. When you own P&G, you are owning a stake in the mundane, essential heartbeat of the global consumer. It's not glamorous, but glamour fades. Necessity endures. For a retiree looking for a dependable source of income that grows steadily to help fight inflation, P&G is a classic choice. It's the steady, reliable workhorse of a portfolio. The third company I'll mention is one I've had a long and happy association with, and it perfectly illustrates a different kind of moat: Coca Cola. Now, here's a business that is breathtakingly simple to understand. They make syrup concentrate and sell it to bottlers who turn it into the finished drink. But its economic power is extraordinary. Coca Cola isn't selling a brown, sugary, fizzy liquid. It's selling happiness. It's selling a moment of refreshment. It's selling a brand that is recognized in every corner of the globe. That brand is the widest moat imaginable. You could have all the money in the world, you could assemble the exact recipe, and you could not create Coca Cola. The brand is in the mind. It has taken over a century to put it there. This gives the company unbelievable pricing power. They can raise prices over time, and people will still buy. The demand is incredibly stable. It's a true global royalty business. They get a small toll on an enormous, never-ending river of consumption. Financially, it's superb, with very strong cash generation. And its dividend record? Stellar. While not a dividend king by the strictest definition, its streak is in the 60-year range as well. It is the poster child for a shareholder-friendly, dividend-focused culture. The current yield is often more attractive than the others, frequently hovering between 3% and 3.5%. The magic of Coke for a retiree is the combination of that ironclad brand moat, its global reach, which provides diversification, and its generous, growing cash return. It's a business that throws off cash like a fountain, and it's committed to sharing that with its owners. It's the ultimate get paid while you wait investment, and you can wait with immense confidence. Now, it's crucial to step back and see what these three examples have in common. They are in non-cyclical, essential industries: health, everyday consumables, and simple pleasure. They have globally recognized brands that command customer loyalty and pricing power. They have fortress-like balance sheets. They have cultures that have prioritized returning cash to shareholders for more than half a century. And their payouts are sustainable, leaving room for continued growth and adaptation. You won't get rich quick with any of them, but you are very unlikely to get poor owning them. They are built to endure and to provide for those who own them through all seasons. A final critical word on implementation. Even the highest quality individual stock carries specific risk. Something unforeseen can happen to any single company. Therefore, the prudent retiree should think in terms of building a basket of such high-quality dividend payers. Diversification remains a fundamental principle of safety. You might own these three and then add other companies that meet the same strict criteria, perhaps in sectors like utilities, certain financials, or other consumer staples. Alternatively, and this is an excellent path for those who don't wish to analyze individual companies, you can achieve this through low-cost, high-quality, dividend-focused, exchange-traded funds, ETFs, or mutual funds. Look for funds that track indexes of dividend aristocrats or dividend kings, companies with long histories of raising dividends. This gives you instant diversification across dozens of such businesses with a single purchase. It's a simple, effective way to harness this philosophy without having to manage a portfolio of individual stocks. In the end, investing after 60 is less about genius and more about wisdom. It's about choosing not to be clever, but to be rational. It's about trading the temptation of spectacular gains for the blessing of peace of mind. By focusing relentlessly on quality, on durable businesses, strong finances, and a proven culture of sharing, you build a retirement portfolio that isn't just a collection of ticker symbols. It becomes a source of quiet confidence, a collection of well-tended orchards, each tree mature and strong, reliably producing fruit season after season. You can sit in its shade, enjoy its yield, and rest easy, knowing the roots go deep and the foundations are solid. That is the goal, and it is a goal well within reach by focusing on what truly lasts. Thank you.